Thank you. And it's really great to still see so many people in the room for this CEO panel. Great to have you. I think we heard a lot from supervisors. We talked a lot with industry, heard from industry. But let's hear from the CEOs. Let's hear from those who run the companies that we've been discussing also so much. And not all of them are here in the room, but I'm really happy therefore that Adrian Gore could join us. Adrian is the founder, executive director, and group CEO of Discovery, and I'm very happy he's here. Also online, and I'm not sure if that can be shown, but we will have Charles Brindamour, the CEO of Intact Financial Corporation. We will have Tony Cheng, President and CEO of Reinsurance Group of America. We have Pauline Leclerc-Glorieux, very happy to have her on board, the CEO of BNP Paribas Cardif. And finally, I hope you made it. You did. Wonderful. Yuan Lee, the Group CEO and President of AIA and Chairman of the Geneva Association. And it's my pleasure to welcome you all. If you want to know more about these very interesting people, there is an app, and in the app are bios, and I can highly recommend you look into those. But in the interest of time, I am going to move to the questions so that we can actually hear from the CEOs. And the first question is the same question for all five, and we have about 25 minutes, so I'm asking you to all try to stick to a minute of five. And the question is, if you reflect on the different business models that you have, the footprints and the outlook of your businesses, if you look at that, can you share with us what you think are the biggest challenges that we will face as a global insurance industry in the next 5, if you can look that far, maybe 10 years? And moreover, what can we do to face those challenges? And I will start in the room, and I'll give you the floor, Adrian.
Thank you, and thank you for the opportunity, and it's good to see everyone. It's a pretty tough question. I can maybe answer it from my perspective, and I see my colleagues, some I know very well, online. I mean, I guess there's a few obvious themes that from our company we think about. One is obviously macroeconomic risk, the geopolitical environment, the entire kind of world at the moment is in flux. For us, the manifestation on interest rates and exchange rates is a very complex issue, and we expect volatility, and that's difficult to manage. I would also say the obvious issues that are fundamental, the technology revolution, AI, data security, consumer protection, these are themes that we are focused on, are very, very complex. And then there's regulatory complexity, accounting standards, changes. There's a number of things that we're grappling with. But I wanted to maybe make a few comments as a life and health insurer that I think are maybe specific to us. One is, and central to our model, is an increasing understanding of mortality and morbidity risk. The understanding now that behavior change is a very big component of mortality and morbidity risk. When I trained as an actuary, a long time back, we were kind of taught things are pre-existing, you price things at a point in time. We now know that behavior has a dramatic effect on mortality and morbidity risk, and I think as we go forward over the next decade or so, that's a very, very big issue. The other is, in the markets we are in, there are typically aging populations, very, very complex to manage, increasing levels of chronicity, again, driving up all kinds of risk curves. The issue of aging populations and rising healthcare costs is one of the biggest things I believe we face, both on the mortality and morbidity side. I have to say, as a health insurer, the complexity of trying to keep healthcare costs under control cannot be overstated. It has a pernicious ability to inflate at rates way above price inflation, and that's a function of both demand side and supply side factors. On the demand side, people are getting sicker, they're living longer sick, and that's a problem. On the supply side, healthcare is an unusual issue. Technology in most industries drives prices down. In healthcare, drives prices up. So Ozempic, every time there's a new drug or a new technology, we're required to fund it. And that's a very good thing for society, but there's a cost to it. So there's a kind of inherent CPI plus 3 to 5% inflation rate of healthcare costs. And managing that, getting society to understand that is a very, very difficult issue. So when you kind of overlay that on consumer duty, it's not a simple thing to manage, and I wanted to mention that. The other point I would mention is we are very focused on is in a world that has moved from defined benefit to defined contributions. I mean, it's anecdotal, but some of the studies are coming out. All the risks have been shifted to the consumer, to the customer. And in a world of considerable volatility, economic volatility, people are living longer, life expectancy is unpredicted, they need healthcare expenses. People are not adequately advised on how much they need to save, when they should start saving. A lot of behavioral factors take place in that regard. So kind of trying to coalesce an understanding of life expectancy risk behavior into the retirement or long-term savings piece for us is also an issue. So we see a lot of issues around aging, chronicity, retirement saving, behavior change as fundamental to how we see ourselves operating. Obviously, AI technology has got a lot of complexity and a lot of really complex things to manage, but it's a massive opportunity, we think, in our industry that will shape a lot of what we do. Clearly, it has a lot of potential impact on operational issues, call centers, service issues, but in fact, in managing risk, we believe it has a massive, massive potential to personalize what needs to be done. So we're excited about it, and maybe remedies, and obviously, you've applied your mind considerably to this. I guess an appeal from as a CEO for a kind of agile regulatory environment. We have to embrace this stuff. There's a lot of risk in it, but we have to somehow kind of manage that risk of all the difficult issues that come about with AI, with data protection. But it's a critical tool. The other point, I guess, is we need more innovation, not less, in a very difficult environment. So, we need space to innovate, and I think that's an important issue. And then on the issue of consumer protection, data protection, these are critical themes, but in a world, again, of considerable flux and flexibility, we're going to need space to understand this. So there's a lot of varying things in our world, but I guess we see considerable risk from an economic perspective, from a kind of a healthcare, morbidity, mortality perspective, but considerable opportunity to really, as an industry, to make an impact on the people that we serve.
Thanks, Adrian. And I much appreciate that you start from some of the challenges you see, but then come to some of the, at least, ways to find the solutions. And because I think that's how we need to think. But I hear protection gap for pensions, I hear for health, and I hear the question on how can you increase demand when you have to in a world with new technology. That doesn't sound unfamiliar, but let's see how that is with the speakers that we have online. And let me start with the chairman of the Geneva Association, Yuan Cheng. Can I give you the floor to hear your reflections?
Okay. Thank you, Petra, for the introduction. My pleasure to be here today. And hi, Adrian is a good friend. I think there's no shortage of challenges for us to tackle, as you've heard. And I think Adrian has done a beautiful job to encapsulate, the major issues that we think about. I think many of these themes, as Adrian suggested, are universal, such as climate change, AI, digital innovation, cyber risk, protection gaps. And I agree that addressing these challenges is crucial to our development as an industry. But I would also like to dive deeper into the issue of accelerating and excessive medical cost inflation. This is an issue that is affecting insurers, governments, and consumers alike. It's a topic that's very close to my heart, and I'm sure very close to Adrian's heart as well, being a leading life health insurer in Africa. I think, as you know, IAIS is one of the largest life and health insurers in Asia, with presence in 18 markets. In our region alone, healthcare expenditure is expected to exceed $4 trillion by 2030, with costs rising almost twice as fast as GDP growth. Around the world, we see accelerating medical cost inflation that's straining healthcare systems. High out-of-pocket expenses mean that individuals are bearing the brunt of this, making healthcare less affordable each year. Families are thrown back into poverty because of sickness to a family member. Resources are pulled away from critical areas such as increasing health disparities and, unfortunately, sometimes the patient harm. The issue largely stems from market failures such as information asymmetry, moral hazard within the funding models, supplier-induced demand for high-cost procedures, and fragmented care systems. I think the World Health Organization estimates that around 20 to 40% of healthcare spending globally is wasteful. Much of this comes from antibiotic overuse, unnecessary cardiac procedures, and orthopedic treatments where less invasive alternatives could be more effective. So what can we do as insurers? As insurers, we are working on several fronts. We are repricing products, incentivizing preventative care, promoting greater health, greater wellness. We have a collaboration with Discovery where we integrate vitality into our insurance solutions and improving provider management. But this is not something we can fix alone, I think, as an industry. Regulation has a critical role to play. To address this issue, I would encourage regulators to focus on 3 areas. Firstly is to introduce evidence-based guidelines to tackle unnecessary treatments and ensure patients receive the right care at the right time. This is actually quite crucial in the region that I operate, that we in AIA operate in. Shifting to value-based care models by moving away from fee-for-service structures that reward volume over quality, and improving cost transparency so consumers understand what they're paying for and why. So a responsive regulatory framework that promotes greater accountability and inclusion creates a more competitive and equitable healthcare industry, and customers emerge as the biggest winners. So I'll end my comments here on this question.
Thank you very much. And you can't see the room, but I can. And there were several people nodding when they hear you talk. And I think we tend to often talk about the cyber gap and the net gap, but clearly the health gap is one that is also needs to be addressed. And I clearly hear also from Adrian sometimes needs slightly different thinking on how we deal with that. So, but I think I heard you give some suggestions. Let's hear from the other CEOs on the line. And may I go to Pauline, I guess from France, calling in. The floor is yours. You need to unmute yourself, or someone needs to help you unmute. No.
Is it right? Can you hear me?
This is perfect. This is very well. The floor is yours.
So, technology is everywhere. Thank you very much. And now, elaborating on what both Tony and Vincent have shared, I like to think about the question around what could we be missing. Now, if we think in terms of risks, we have comprehensive risk frameworks, we identify risk, we price them, we monitor them, we look out for trends. We have capital buffers to make sure that if anything wrong happens, we will still be there. So I'm trying to think on a 10-year horizon, what's next? What could we be missing? And this revolves around something which has been mentioned quite a lot, which is how do we continue doing our job as an industry to reduce this insurance gap, which is linked to rising healthcare costs, aging populations, all the things which have been shared. And around this challenge, there are 2 things I would like to highlight. The first one is around the long-term savings and protection needs of individuals. This has already been discussed. And I think we need to think about how do we make sure that we keep having life insurance products which are relevant to the individuals. As you were mentioning, we have to, you were mentioning the fact that one of the issues is that we tend to transfer the risks to the individuals, and we're not really sure they get the right advice as to how to bear them. So I believe we need to work more on this, and I see two elements. The first one as insurers is how do we make sure we have access to the asset classes which will enable us to match our long-term liabilities. Now, financial markets have evolved a lot over the past 15 years, and this means that very simply having access to the right asset managers which have the scale and the technology to access both listed and unlisted assets is something which is not as straightforward as before, and I think this is something we should be looking for. The second element is this ALM issue. You cannot just say that an insurance product is a long-term insurance product is an asset issue. Of course, it's an ALM issue, and making sure we keep that intimacy between assets and liabilities is absolutely essential, especially if assets are becoming more complex and liabilities are changing because of customer behaviors. So for me, this means we need to think about how we keep that intimacy between the insurance part, liabilities part, and the assets part. So that's my first point. Long-term savings and protection products, how do we keep them relevant? How do we keep the access to the right asset classes and keep this intimacy with ALM? The second thing I would like to highlight here, again, thinking about this insurance gap, is making sure we keep the balance between what is at the core of our business, which is balancing mutualization of risks with selection of risk. Now, the risk I see is that changing customer behaviors could ultimately, or industry dynamics could challenge this. And I would like to highlight one element which is linked to regulation. There are a lot of discussions right now about open insurance, about in Europe, the financial data access framework, with this sort of, I would say, a bit simplistic idea, which is that if you can sort of describe an insurance contract with a limited number of data and give that to clients, they will be able to make better choices. Now, I really see a risk that when we do that, we have unintended consequences whereby clients, individuals will switch contracts without having fully understand the impact of what they are doing, ending with products which are not necessarily adequate for them, increasing adverse selection. So at the end of the day, we will have products with higher prices and not necessarily adequate for clients. So this is what I wanted to share. For me, on a 10-year horizon, the challenge, the focus is really beyond looking at the risks. How do we remain focused on bridging this insurance gap and take into account those long-term trends? Thank you.
Thank you, Pauline, and excellent, because I think besides what we heard on the health and life risk, and also how do we deal with data and data privacy, how can we understand whether or not insurers sufficiently understand the risks they are taking when risks are more transferred to them. What I hear you also say, and I agree, looking forward, mutualization, and at the same time, pricing risk in a time with more data and more tools. How is that? And I think you definitely need people who understand insurance to have that discussion in order to actually draw the right conclusions. And you alluded to that, I would say, very much in a good way on open insurance, and how easy it may seem, but it is not really in reality. Thanks for that. Let's see if we can identify some additional things we need to focus on. Let me move to Charles. Charles, what is your outlook for the next 5 to 10 years?
Thanks, Petra. I would say headline for me is risk is booming, but risk is our business. And I think our industry is very competitive and has demonstrated tremendous resilience, over a number of decades. And I'll provide a P&C lens here. And I would say the biggest challenge, if I look 10 years out, is the fact that, our job is to de-risk society, but the nature of correlation in the emerging risks is really being challenged. And the power of diversification also is being challenged. And I will zoom in on the two biggest pools of risk, which I'm sure you've talked about. First of all, cyber is an area where, there is a massive insurance gap. It is a fast-growing sector. in the P&C industry. But this is one where the traditional geographical diversification is really being challenged. And this is also one where the historical body of evidence is not super helpful to figure out what risk looks like going forward and what tail risk looks like. I'd say to answer your question directly, the bigger issue for the P&C industry is definitely climate change. And the difference between cyber and climate change is that we are present and insuring trillions of property values globally. And here, obviously, the diversification across countries has changed a fair bit because there's a deep trend that's impacting most jurisdictions globally. 23 was the warmest year on record. 24 is likely to beat that. We're operating our business assuming that we'll operate in a 3 to 5 degrees warmer environment, and this has deep implications. One, if you just look back, natural disasters have increased over the past 40 years by a factor of 4x inflation adjusted. And yes, there's an underinsurance issue. Every dollar insured has $3 uninsured, whether it's public assets, whether it is underinsurance or just no insurance. And it is on one hand an opportunity. On the other hand, some of it is really, really hard to insure. And if you look 15 years out and you assume that we're headed for 3 degrees or more, then the trend we've seen will continue. And some of it is irreversible at this stage. And if you model it by peril, what you find out is that whether it is hail, wind, or convective storms, water, fire, I'm Canadian, fire is a big issue for us. You can see that the inflation-adjusted cost of natural disasters will increase by 50% over the next decade. That's manageable in my mind. I don't think it's a tail risk issue, but it is a deep trend that will challenge affordability and availability. The other issue with the next 15 years, Petra, is the fact that beyond the 50% forecasted increase in natural disasters, the low return period at take less than 1 in 10 years, these will double. So the intensity is up, and I think the cost of capital as a result as well is up. So the question is, how do we as an industry continue to de-risk society in a world where diversification is challenged and there's a steep, deep trend prospectively? And I think, the answer is, and I believe we've done that certainly in the North American context and in Canada in particular, is the fact that we can't just look at pricing as a solution to continue to provide coverage. Obviously, pricing is really important, but what insurers need to do, in my mind, is to look at every lever of the value proposition that we provide to help consumers de-risk themselves in the first place, and then when the event occurs, manage to lower the indemnity. And by that I mean your product needs to be fit for purpose. Products that were historically built for fire don't get the job done anymore. We've unbundled our products to match them against the perils that are changing so rapidly. You can't collect the same data to underwrite and price these products. You have to change your claims value proposition. You have to change your supply chain. We've invested in the supply chain. We have a home restoration company. And then prevention, in my mind, is the lever that has a lot of upside because it changes the conversation you have with your insurers and with your customers, and it helps manage the loss in aggregate. And I think it's by working on every lever of our value proposition that the industry, I think, will be successful in de-risking society and growing on a sustainable basis.
Thank you, Charles. And de-risking society is interesting. We often say insurers manage society's risk. But I think what I hear you clearly say is we need to go beyond that. We need to help society actually de-risk with the gaps that are coming in cyber and in NatCat and going up very fast. 20% of the risks since 1980 in the Europe region have been taking place in the last 3 years. So that is really exponential. But so we add that to the things we need to work on, definitely on the P&C side, cyber risk and NatCat. And I hear some concrete ideas also on how we can do that. But I agree on this overall approach that needs to be taken. Now, having heard all these gaps and the risks that we need to insure, fortunately, we do have reinsurance as well. And from that perspective, I'm very happy, but also very interested in hearing from you, Tony. What role do reinsurers play in this in the next 5 to 10 years, and what will be your challenges? I'm sorry, Tony. What I'll do is I'll keep your minutes for later and give you a chance to come back.
How's that now?
Oh, there it is.
Is that yes. All right, thank goodness. All right. Well, I was mentioning, look, it's great to be last here because really very much building off the previous prestigious speakers. You know, like many life and health insurance, reinsurance companies and insurance companies, we've had one purpose for 51 years, which is make financial protection accessible to all. And we do this through 3 ways. We firstly help our clients create new products. We make them easier to buy, and we make them more affordable. You know, and this not only is very critical for our people and our stakeholders, but it very much drives all our business initiatives. So firstly, creating new products. We've done that for many years throughout the world, in Asia, in the US, and in EMEA, addressing many of the issues actually that Adrian and others have raised with regards to behavior and as well as aging populations. Making it easier to buy. Once again, I'm sure it's been discussed throughout the week, which is through data, underwriting, and the use of technology. And thirdly, making these products more inexpensive. That one's a bit more subtle, but it's really through capital solutions on new sales or blocks of transactions. And that obviously makes insurance industries as a reinsurer more resilient. So it's this third area that I just want to speak briefly further on. Now, this is not a new direction for RJ. We've been actively contributing to the development of these regulations of using reinsurance for not only risk management purposes in the life and health industry, but capital management purposes for many, many years. In the US for over 30 years, where we helped pioneer this market. And this has meant insurers are able to reinsure not only their asset risk, but also some of the specialized, some of the other more specialist risks like LTC, ULSG, variable annuities that the industry has had some challenges in, to reinsurers that focus on managing these risks. So, for example, we completed one transaction 2 weeks ago that was publicly announced. And this has meant that the capital that backs the life insurance liabilities is held by specialist reinsurance companies, once again, that specialize in the management of these risks. So that's in the US. In Asia, we were also one of the pioneering reinsurers working on this. And I remember working with the Japanese regulator over 2 decades ago. Obviously, throughout that period, we've worked with the other Asian regulators. More recently, we're seeing a very strong uptick in transactions in Japan and the initial transactions in Korea. In the UK, there are very effective risk transfer markets in the pension risk transfer space on longevity, and a developing market in co-insurance. So it is in Europe that we feel there is the greatest opportunity for RJ to participate in this conversation and ensure a material portion of the many trillions of euros of life insurance liabilities is eventually backed by specialist reinsurers in order to ensure greater capital is brought into the markets and increase the resilience of life insurers and the life insurance industry in general. So, you know, look, as the leading life and health global reinsurer, I feel it's our responsibility to be part of these conversations, and obviously I welcome any further.
Thanks, Tony. Thanks a lot. And I think with that, that is a privacy, that we get this overview from 5 CEOs. I do think it touches on a lot of the topics that we see as well, but I would like to dive a bit more in some of them, but not the same topic with everyone. So I'll touch on NetCat, then on digital. I'll get back to you as well, Adrian, on that one. And then what is societal role and how consumers behave and what we can do there. And if you allow me, Charles, can I start with climate and the NetCat gap that we see, since you already, I think, said some very interesting things, but you ended on the note affordability, availability. That is the challenge that we see. So if you look at pricing of insurance in the different markets in which you operate, what can insurers do to deal with this issue?
Thank you, Petra. I think when you think about availability or affordability, you know, there are probably 3 main things that will determine the amount of availability and then affordability in the market. One is, can you manage the tail risk, right? Can you model it? Can you price for it? Can you diversify it? That is very much an issue in cyber. This is less of an issue for most insurers with regards to climate change. The second key issue for availability of the product is when frequency is to a point where you go from insurance to maintenance. And that is a key challenge at the moment. And that's why, Petra, in my mind, it's not just pricing for risk. It is really about de-risking. And that, I think, is the role that insurers and reinsurers and regulators have to play. And I would say there's, in the markets where we operate, both in personal lines as well as in commercial lines, there's a very good degree of availability. But I'll give you an example where we've got an availability issue and what a firm like ours can do and what regulators can do to solve this notion of going from insurance to maintenance. And it is flood in the context of Canada. 10% of Canadians have a hard time insuring themselves for fluvial flood. In other words, rivers getting out of their bed. The challenge there is that this will likely expand because of the trends I've talked about in the previous question. And so what's the solution there, and what's the industry's job, and how can the regulators help? I would say on this one, the reason why there's an issue and the risk is up is that land use planning has been problematic. Second, building codes and construction standards are not up to snuff for the world in which we invest in. Third, infrastructure investments, whether they're subterranean infrastructures or public infrastructures in general, haven't been built with adaptation to climate change in mind. And these are 3 areas beyond our day-to-day work that we need to be heavily involved to deal with the areas that are not available, where specific insurance is not available, and that might expand over time. And the fourth element there is prevention. We work directly with cities, over 100 cities. We work directly with provinces and the Fed to really tackle risk in relationship with natural disaster. And in my mind, the regulators need to get involved. You're a really important voice for decision makers. and being part of the effort to de-risk society is critical. Traction is very difficult because it's difficult to engage decision makers and elected officials on adaptation per se, and I think regulators have an important role to play. The third element where availability is challenged is when you cannot price for risk. The P&C industry is very competitive. We operate in environments where, if you take Canada, there's over 100 insurance groups. You compete for one product, one province with, in average, 20 to 30 competitors. So competition is not the issue here. If you can't price for risk, you'll have an availability issue. And where I think the availability issues are the greatest globally is where companies are prevented from pricing for risk. And I would say this is obviously an area where regulators can make a huge difference. And so first, focus on risk and the cost equation. Second, make sure that the framework in place lets the competitive forces take care of pricing for risk. But I do think that de-risking is very important, given how steep the trend is when it comes to climate.
Thank you, Charles. Thanks a lot. And clearly what I hear you say is this additional role or expanding role of insurers in assessing the risk and supporting society, sometimes at local level, to actually de-risk. But I also hear the call for regulators to get involved in and supervisors to get involved in that discussion. Maybe also technology can help here in satellites that are following developments of floods, thereby learning how floods develop, thereby giving information how we can prevent next damages coming. But that does bring me to technology. And I'm going back to here in the room to you, Adrian. I mean, moving to the technology topic, we see generative AI, we discussed it a lot, but we see, of course, beyond that, I think we are only at the start of use of AI in a time that we have increasing amount of data, quantum computing, lots of talk there, but I think also a lot of work, it's coming. And that at a time where you have a fundamental role to pool risk and to mutualize. So how can the insurance industry really harness the benefits as what you do with data of the new technology, while at the same time not losing sight of the consumer's needs?
I actually may make comments very analogous to what Charles has said in the context of life and health. I mean, our entire model is predicated on the hypothesis that changing behavior brings risk down. We've done this now for 3 decades, and the data emerging now is so incredibly compelling. First, we find that the causal effect of behavior change is dramatic. So people, going from zero physical activity towards a lot of it brings mortality down dramatically. It's universal and equitable. So in fact, it affects people, older people, sicker people even more. So it's an unequivocal force, and it's a very different. We talk about it kind of loosely. It's a fundamental change in insurance markets, because insurance has been, I think, to pick up what Charles has said, has been about pricing risk. You price it on life insurance at a point in time, you underwrite the life, and then you charge that price thereafter. And you assume in the valuation models that there's certain kind of averaging out over time. But the reality is, I think the fantastic thing is, we are completely aligned to our customers. If they're healthier, we're more profitable. There's no dissonance at all. There's no actor beside government, I think, that has that same alignment. So if we can manage risk rather than just price it, the effect on our customers, on society, on the companies is dramatic. So coming back to your question, the use of technology, AI, data, in that kind of methodology is so powerful. Our entire model, and we work with many companies. We work with Yuan we've been on a similar journey. He's also been a pioneer in this. But the concept of actually incentivizing people to be healthy, we can afford to do that, because when they're healthy, they drive the actual surplus of the company. So we completely align to the customer, and you can create this kind of shared value loop that's good for the customer, good for us, good for society. But you need data, you need AI, to your point. And the critical thing here, and it gets back to maybe the protection gap, and I really like the earlier speaker's points about relevance and about the protection gap. Our products have got to evolve from being just kind of passive protection products they're good for society, ones that are different, that are active, engaged, and dramatically make people healthier, don't just price the risk. And the ability to do that, I think, with AI and technology is amazing. We are on a journey now, I think, with many others, where we have the ability to actually understand the specific risk factors of an individual, suggest to them, guide them what they should be doing, kind of a next best action, and incentivize that change. There is no downside at all. It's only good for them. And if they do that, you get this kind of virtuous cycle. So to make the point maybe slightly differently, maybe to come to your point about the risk pooling, if you look at life insurance currently, I'm not a critic, I'm a great fan of it, but it pools, in a sense, controllable risk. If you accept that behavior has an effect on mortality, then if you don't take behavior into account, you're pooling controllable risk. You will know that insurance is about pooling uncontrollable risk. If you've got a controllable risk, you get adverse selection. So by kind of changing behavior and pricing that appropriately, you leave in the risk pool the proper uncontrollable costs, and you get a much more efficient process. So I believe with what's coming on with data and with AI, the ability to offer products that are less expensive, less adverse selection, much more engaged in our customers, therefore much more relevant, and customers in using them become healthier, and they see value rather than an old-style product where you're just simply paying for protection. And if we get that right, and I believe we can as an industry, we'll bring prices down, make it more accessible, more financial inclusion because of the price levels, and make a massive difference to society. And I think in that process, the industry has the ability to kind of move from a passive force for good to a much more active one, where it's not pricing risk, but in fact actively managing mortality and morbidity. And I think that'd be an excellent thing.
Thank you, Adrian. And then, but just because I'm sure it's in some of the heads, so I'm just going to ask you. So if you start to look more at behavior and really incentivize behavior, because, and I think you're right, a different behavior will probably result in a healthier life or longer life, a better quality of life. Yet I think we all know that if you do that, there are also those you won't reach because they like their behavior as it is, or there are those who are just have an unlucky pick, unlucky hand, and for reasons that are not related to the behavior still get sick. Or so how do you not exclude those if you start to include behavior?
Yeah, those are critical questions. I mean, the one point to make is we know from behavioral economics that people don't make rational decisions necessarily. So the incentives are, we know in healthcare people consume healthcare but under-consume prevention. You know, it's 30 years away. Why would I go through the difficulty of a run now if I'm going to affect my benefits in 30 years' time? So you need incentives to break that cycle. The second point is that it's about making people healthier. It's not about healthy people. But there's no suggestion that you penalize people. So you're simply trying through incentives to get that behavior change. If they don't change that behavior, there should be no real jeopardy in the process. But using a positive incentivized approach has no downside. And if you can achieve that and you can match the cost of the incentives with the reduction in mortality over the population, you get a good result. So it actually ends up giving you a much more equitable, fair product. And people that are left behind that can't do it are not penalized. They should be no worse off over time than they would have been.
But the pool as a whole will be better.
The pool is bigger.
Yeah.
And more engaged rather than smaller and less engaged. It's a different result socially.
Thank you. And I'll stay with this question. I'm going back online. Tony, maybe on this question, I think again, maybe from a slightly different perspective, for all these new data sets, more data, big data, tooling to deal with it, and at the same time, this balancing between pooling risk, but also pricing risk. What's your view on that?
Yeah. No, you've hit on one of the great questions, right? Is, you know, those left behind, for lack of better words, and Adrian's very much addressed that. To me, that's a great opportunity. I mean, you know, a lot of our business actually, like I said, our purpose, make financial protection accessible to all. So a lot of it is around elderly products, around simplifying the underwriting in order to at least put a price point on these these other lives. They're a great business opportunity, and the demographics are obviously moving that way. Look, I would just want to make a couple more points on AI and technology in general. You know, Yuan Siong will know better than me, but obviously with the technological advancements, it's going to make distribution more efficient. It's going to make the middle market more accessible, which once again is all our purposes. Right now, in certain pockets around the world, that middle market is not being served because the commissions are just too low, or it's too hard to place the policy, right? Make it easier to buy. So technology obviously adds and enhances that. And then just from a different perspective, we all know that technological advances, you know, creates the increased need and value for high-end professionals. We've got many high-end professionals, doctors, actuaries, underwriters. Can we attract other types of professions to the life insurance industry, life and health or general or P&C industry, so they can not only take the information, the analytics, the data, and the outcomes from the technology, but as we know, when they can combine that with business problems to solve industry issues, then that's really very valuable for society. Very, you know, great contributions from these individuals. So I think a lot of the data and you know, companies like Discovery and AIA and others have been able to show the attracting of that greater talent, and that's as important as anything for our industry.
Thank you very much. Yeah, so being able to show the benefit, using the data and the technology to do that, and then indeed have, with the societal role that insurance has, indeed maybe not only mitigating and managing risk, but actually helping to de-risk. The question and more societal question, and I'll end with that with the two of you, Yuan, Cheng and Pauline. What actions can insurers then take to promote and enhance the role they play in addressing challenges and risks faced by society, knowing that, it was said, it's also an opportunity for this industry. There's so many additional risks, but that will only work if people actually start buying then insurance. So how can you face that new role in society, and what will be your views on those? And let me start with Yuan Cheng and then move to Pauline.
Yeah, just before I tackle this, I just supplement my thoughts on what Adrian was discussing around his behavioral change model. And I think there's, you've pointed it out very correctly, Petra, that the pool has to improve through the program in order for it to be able to bring everybody along. If it's just rewarding the people who are taking positive action and at the expense of those people who do not take positive action, then the problem that you talked about, where people be left behind, actually exists. So it's important that the whole program incentivizes the pool, and the pool as a whole, improves and it becomes healthier. And now on your question about the role of the industry in terms of promoting societal resilience, I think we must acknowledge that we do play a very crucial role. Our industry performs two vital functions. First and foremost, we act as a social safety net, providing reassurance and certainty in uncertain times. Secondly, by channeling the premiums into productive patient capital, insurance enables economic growth and promotes financial market stability. In terms of the first function, the first function enables the second, and the responsibility is on us to drive greater awareness, affordability, and accessibility to make insurance more inclusive and provide an even wider and stronger safety net, which is exactly your point, that people have to buy insurance. Digital technologies, including social media, are incredibly valuable for disseminating information, broadening reach, and promoting greater risk awareness at lower costs. I think there's a lot of potential that technology we can leverage on in terms of technology. With the data available to us, we are better placed than ever to price risk and develop innovative products that cater to the unique needs of underserved customer segments. By offering the greatest choices of how and when and where to interact with customers, we can ensure better access to the tools they need to manage their resources effectively. On the second function of insurance as a driver of economic growth and stability, as an industry, our objectives are very closely aligned with the broader public policy mandate. We share the same aims of supporting society to become more resilient. We must strengthen the connectivity between the industry's purpose and key national mandates, such as supporting critical sectors including healthcare, infrastructure, and decarbonizing our economy. However, we must remember that insurers do not operate in isolation. Our actions are deeply intertwined with the broader economic, political, and social needs that shape our environment. It is only through greater public-private partnerships that we can create the necessary solutions. Policyholders are crucial to enable frameworks that support the growth and stability of the insurance world, so we can continue contributing to a more resilient and sustainable world. I'm confident that you all agree that insurance is much more than a financial product. It is a catalyst for positive change. And each of us must share in the responsibility of unleashing the full potential of our industry as a force for good.
Thank you very much. And insurance as the catalyst of positive change. I'm going to take that with me. That is not always easy, and I think we've heard that, but I also hear some ideas on how to deal with that. And because there is this role in society, Pauline, and what I really liked in the first answer that you gave is that you actually also touched on the core. It's hardcore, but it's the core of insurance business, ALM. Getting in the right assets to actually make sure you can provide the products that people need. But then you also mentioned that you also somehow need to find ways to have people buy those products. So what is your view on this societal role coming from a really financial context, but then reaching out to society?
Thank you, Petra. Now, listening to all of you, really what you said resonates a lot with how we see things at BNP Paribas Cardif. Charles, you talked about de-risking society. Tony, Adrian talked about accessibility. At BNP Paribas Cardif, we like to say that our mission is to make insurance more accessible. So we see that we are all focused on how can we have this positive impact on the individuals we insure, because we want them to be able to engage into their life projects, knowing that if something goes wrong, they will be protected. And it's not a pure just financial compensation. So for me, this is absolutely essential. And this is also rooted in reality. We recently conducted a survey over 20 countries. And the result of that survey is that we asked people, do you feel protected enough? And 36% said, no, I don't. So this issue, Petra, which you were mentioning, which is how do we get people to buy insurance, to find the right insurance product, is really critical. The way we frame it, and here it echoes also what Tony said, is we say, okay, we want to make insurance easier to understand, easier to subscribe, easier to use. And I would like to focus on one initiative around subscription, which I think has a lot of meaning, which is how we talked a lot about, how do we make the pool of risk healthier? I think there is another question, which is how do we make sure that we include as many people as we can in the pooled risks? And how do we take into account medical advances when they occur to maybe bring back people which we used to exclude? Now, this is something which, as many insurers, we've been doing for a long time. You take illnesses one by one. You look at them. Last year, we relaxed our underwriting rules for people with irritable bowel syndrome. And we're talking reality here, people who could not get insurance and which we are now able to insure on death risk, for instance, or temporary disability. Only last week, we also relaxed our underwriting rules in France for people who are HIV positive, and we believe we will now be able to insure 90% of them. And I think this is something which we should really work on. And this is also a message to regulators to help us have the right framework, which enables us to continue with this mutualization. Sometimes, once again, we talk about how can we get prices down. Let's make sure, as you were saying, Petra, that it's not to the detriment of small pools of people who also need to be insured and to remain into the pooled risk. So that would be my message. We need to make insurance more accessible. This is, I would say, a daily job, and we need the right regulatory framework to help us do that.
Thank you very much, Pauline. And that already brings us to the end of this panel with, I think, first of all, the insight that a lot of what we talk about also as International Insurance Association are topics that are in top of mind with our CEOs. The notion that the fact that it is a riskier world, that's true, but also that there is an opportunity for insurance, and that actually with technology, I hear that, and a consciousness. I've heard each of you say the word consumer and think about consumers, to reach out to more people, increase pools, have a better insight in risk, use that to do more to insure those risks, but being conscious to then also be inclusive. I hear that all. I also hear the call for supervisors and regulators to join into that effort. Let's continue talking about that. Let's keep working on that. But for now, let's wrap this one up. I know how busy you are, so thank you very much for all being in the call, and Adrian, for you to be here in the room. And let's have a big applause for this panel. Thank you.